Money Show.
Personal Finance with Warren Ingram.
Warren Ingram, who is a director at Galileo Capital. He's a personal financial advisor. The world is crazy. I always think, people talk about the VUCA world, and I get very cross with people talking about the VUCA world. They say it's volatile. It's uncertain. It's complex. It's ambiguous. And you go, well, yeah. It was in the Cuban Missile Crisis. It was when the Berlin Wall went up. It was when the Sudetenland got invaded. It was 10 years ago. It will get more complex into the future. Of course it's complex. That's what makes it interesting. And then people start panicking about investment decisions. So as we go into 2021, we put 2020 behind us, and I dread looking forward to 2021 because I was looking forward to 2020. We get new US president. We've got vaccines for COVID-19. We've got South Africa hopefully on an economic turnaround path, if but maybe. Lots of fractious politics and noise. What do we do? How do we brace ourselves from a money perspective for the year ahead?
It's. I love your derision of the VUCA comments because it always reminds me of these sort of skits of of some guy deciding he's going to be a motivational speaker, and that's the first thing he always puts up on his slide is the VUCA thing, and I think I'm very grateful sometimes that the world is volatile and uncertain, because if it wasn't, I don't know that you and I would have a job. What would we be talking about if everything was stable and predictable all the time? We'd be saying it was the same as yesterday and it'll be the same tomorrow. So I don't mind the volatility too much, but sometimes a bit less. I think my first comment is we probably need to just reset our big decisions when we're talking about investments. In other words, how much have you got in the big asset classes? How much have you got in cash? How much have you got in bonds, property, shares? And then specifically, how much have you got in South Africa and how much have you got overseas? So to me, those would be the big decisions that you need to get right now. And I think you don't have to worry too much about sweating the small stuff. In other words, if you've got a little bit of overexposure to Apple versus Amazon, I don't think that's such a big call. The big call now is how much have you got overseas versus how much have you got in South Africa, and how much have you got in international shares, and have you got any international bonds? And if you do, maybe you need to be careful. So it's the bigger calls that we need to get right now, and I think we if you're sitting in a position where you feel unbalanced in terms of and that's not psychologically, Bruce, that's around money, then make sure that you get that balance right. In other words, if you've got a overexposure to South Africa, look at the rand now. The rand's, it sounds funny to say it's incredibly strong at whatever 15, whatever it is now. Considering at the start of the year it was in the 14s, but I think it is. It's incredibly strong now given our country's financial position. So it's a good time to get your offshore balance right, and it's much more important to get that right now, and then say, well, I've got the money overseas. I can feed it into international shares if that's what I need to do. But don't dally around 15.22 to the dollar versus 15.18. It's frankly irrelevant. It's important to get it reasonably right and then get the money out and get it invested. So I think that would be my biggest suggestion to someone now. And then the second thing is, once you've got, let's just talk about international, because that seems to be on everyone's mind all the time at the moment, is, what are the international markets going to do? These tech shares are really expensive. How should I position my overseas assets? And I think probably two big themes that are kind of roaming around in my head at the moment, and that would be, I am worried about tech shares just in general. I think especially US tech shares. I think they've had an incredible run, and they continue to defy gravity. So I'm not saying sell them out completely, but if you've enjoyed the ride especially from the start of the year to now, the likelihood is you're overexposed to tech shares. So reduce your tech shares. Don't sell out completely. Make sure you've got proper global exposure. I think the rest of the world outside of America doesn't look too expensive to me. And then I think I've said it before, but definitely, I think my call for the next decade or so is emerging markets. So potentially reduce your tech exposure and add that to an emerging market index or something like that. I think those are big calls that we should be focusing on now. And then looking at South Africa, it's just so fascinating to me. It's somewhere around 2014, 2015, right up to 2017, more and more of the good South African fund managers were starting to temper our expectations around the JSE, telling us they were foreseeing, potentially 0.5% a year of real growth on the JSE, or 1% a year of real growth. And listening to those same good fund managers now, it's interesting to hear them say, we could see 5 to 7% real growth from the JSE in the next 5 to 10 years. And it's not a big call on the SA economy. It's rather a big call on what's going on in the world. The sentiment is shifting away from the developed markets back to emerging markets again. It's a trend that's happened many times. The early 2000s was a good case in point, and then just after the financial crisis again. And I think I wouldn't be surprised to see the JSE go on a tear again. I'm not saying that it'll be the best performing market in the world, but if you've got shares in the JSE, like many of us have, and you're disappointed in the pathetic returns we've had from the JSE over the last 5 years, I certainly am. My suggestion is don't lose faith. I think a lot of people are making terrible decisions now. If I look at where the money's going into unit trust sectors, it's all going into cash, and I think that's such a classic, almost contraindicator, when people are making bad decisions in a collective, and that's what's happening now. They're
but you can understand, though, Warren, why people are doing it, because, people who had money in cash in the last 5 years and were getting 8% have done considerably better than people who have money in shares and were getting 1 or 2%. So now you look at this and you go, and you look, you know what? I know interest rates are being cut by half over the last year, but at least I'm going to get 4% return. Or, if I take a bit more risk and I can buy government bonds, I can get a better return. So I'm going to put it all in cash, because at least I know what I'm going to get. And that, it may be a fool's paradise, but my goodness gracious me, it feels comfortable.
It does feel comfortable, and every day and every week that you look at your statements online, you never see it going down unless you're spending the money. So I get the logic of it, but it sounds to me a little bit like someone comparing one horse to another. So if we're going to stay on that analogy, what's happened now is the horse that's won, the last 5 races, that horse is rather tired, and it's not going to win the next 5 races. There are other horses that are fresher. And to me, I agree with you on the bond call. I think there's still some merit in buying bonds in South Africa, but I just think that we're not talking about the South Africa story. We're talking about the emerging market story, and that will be the thing that drags the JSE up. And I think it's one of those things about being an investor. It's not an easy it's not an easy business at all, and sometimes you have to do what seems completely irrational. Sometimes you have to, they talk about, walking into the burning building. And I think that's really what I am saying now is you've got to do what doesn't feel comfortable. And making returns from shares in particular over long periods of time is a deeply uncomfortable business, and I think that's where we are now. It's don't do what feels comfortable, because comfortable gives you certainty, and certainty means you don't beat inflation over the long term. Unfortunately, if
it's so interesting.
I would find a way.
I ran a poll today on Twitter, and about 800 responses, or thereabouts, and so it's a fairly good slug of response. And it's the most emotive question that you can ask anybody. And you say, on the 1st of January 2021, where will the rand be? Stronger than 14 to the dollar? Stronger than 15 to the dollar? Stronger than 16? Or is it descending into hell? Because I thought that was kind of emotive. More than half of the respondents, 56% of respondents, said either 16 to the dollar or weaker or descending into hell, which tells you where certainly social media world's mindset is.
Yeah, and to me, it's a buying sign. It sounds like capitulation. It sounds like people just giving up on anything. It could be the rand or it could be the JSE. When they capitulate in mass, that's the buying opportunity for investors who are saying, I'm looking for opportunities. And I think at current levels, the rand is really good to convert into dollars. I don't want to shy away from that. And I'm certainly never going to make a rand prediction on air, because I will be certain to be wrong.
And I will remember, and I will rub your face and your nose on it.
Yes, you definitely will remember. That's true. And I won't, and then I'll have to just go with what you say. So I just think, I think let's get the bigger decisions right, and I think that's the thing to say to investors is, don't sell out of your shares. If you feel uncomfortable with the JSE, that means temper it down somewhat. Offset that with some international exposure. But hedge your bets when you don't know what to do. Have one foot in both camps. And I always think that's a much better way of investing than being an all or nothing investor. 100% in shares when things are going incredibly well, and they have for the last 5 years. That's probably the time to reduce your share exposure. This is the opposite situation. It's the time to increase your share exposure, but not to 100% again. That's not what I'm saying. But I think get the balance right and be balanced. And don't have a lot of expectations for 2021. Just be muted and tempered in what's going on, both sides. Optimistic or pessimistic. Those kinds of emotions are terrible for long-term investment success.
It leads very nicely into the question from JJ, which I don't know if you've seen. So let me just give you a little heads up on it so you've got a moment to think about it, because I like to play fair. What are the steps to financial freedom? A nice, short, sweet, clear question. I think you've addressed it in your books. But from a radio perspective, and maybe, JJ, what you can go and do is buy How to Become Your Own Financial Advisor, or become your own financial advisor, or I prefer to read the second one first, which was How to Make Your First Million, because that takes you on a path to financial freedom. But we're going to get a little taster from Warren in just a second. JJ's question this evening: what are the steps to financial freedom?
The Money Show.
Personal Finance with Warren Ingram.
It's actually a huge question. I don't know if we've got enough time for it, but do your best, Warren Ingram. What are the steps, asks JJ, to financial freedom?
I think there are 3 steps to financial freedom. So the first step would be to get yourself debt-free as fast and as soon as possible.
And when you say debt-free, again, this is thrown around a lot. When you say debt-free, get rid of mortgage, credit card, car debt, debt to family, all debt. Get rid of it all before you start investing. I don't think that's what you mean.
And I think that if there's an order to it, then I think get rid of what I would call the bad debt first. And bad debt to me are the debts that attract very high interest rates. So things like credit cards, personal loans, overdrafts, store card debt, etc. Because generally those are debts that you incur to buy things that just lose value immediately. And so those are the ones that I would focus on first. And then, you can take a bit more time on the mortgage. I prefer to be debt-free completely before I'd start investing, but some people, find that boring. So then I'd say, make sure you're overpaying on the mortgage, and then you can start investing. But generally, that would be the first step is, get rid of the bad debts, no question. You can't start investing if you owe banks, on credit cards and personal loans. And then make sure you're overpaying on the mortgage at least, or get to the point where your mortgage is completely paid off. The second step is you need an emergency fund, and that's money that you have in your money market accounts linked to your banking profile. Something that's easily accessible. That is there literally for the unforeseen. I think COVID's taught us that the unforeseen can happen to anyone, anywhere, at any time.
Yeah, but what we've learned now is it's a once in 100-year thing, so we don't need it anymore. I mean, as COVID hit, Warren, all of the conversations we've had about emergency funds were ringing so loud in my ear, because sometimes you can be a bit whingy about the emergency fund. You can be a little bit insistent on the emergency fund. You can be. And then suddenly you were right. But suddenly you were right. Because it's like, it's boring. Put it into a cash account. And that's it's a big lump of money you're asking us to keep separate from everything else. But I have to say that you were completely right and remain correct and completely right. And people are going to rebuild those emergency funds, because I bet you a whole lot of emergency funds have been plundered.
I'm so glad that these are recorded, and I can keep this for posterity.
You were right on this one thing.
Saying,
yes,
Warren was right. Bruce Whitfield said Warren was right. Thank you. I'll keep that. So 3 to 6 months worth of your expenses in an emergency fund, and it's basically an insurance policy that you're funding yourself. That's really what you should view that as. And then the last step is the big question, and that's to make sure that you start to build assets, so that one day when you don't want to work anymore, those assets can generate an income that will cover your expenses. And if you want to calculate that for yourself, what you do is you take how much you spend in a year, and remember, it needs to be all of the expenses in a year. So, if you spend money on a car every 5 years, then it's 1/5 of what you're going to spend on that car. You need to put into that calculation. Your holidays, all of it, and you multiply that, by 20 or 25, depending on how conservative you want to be. And that will tell you how much capital you need to get to your financial freedom number. I call it the lotto number if you want to know, how much money you need to play for on the lotto, or more predictably, save it and invest. And that's the number you're aiming for. So it is a huge question, but if you want 3 simple steps, get debt free, get the emergency fund, 3 to 6 months of expenses, and then get building the assets that will be able to provide you an income one day. And I don't think you need to be really fancy on the assets. I think it's basically, if you go 60 to 70% in shares with the balance in cash, bonds, and property companies, and I'm talking about local and global then, that's what you do in a portfolio like that. Very simple, very predictable, yes, volatile. I'm not saying that, but certainly over time, that will give you the income that you need to cover your expenses and give you the inflation protection that you definitely need. The one thing that a lot of people forget.
Let's get your word, your phrase of the week. And this week, it's a good one because people, I think, are very confused over this term. What's an endowment? So
it's something that gets sold quite a lot, and so just very quickly, it is an insurance product. So when you invest in an endowment, actually what you're doing is investing in something that's covered by an insurance license, and so you're putting money into that. And it does a few things. The first thing it does is it gives you an element of a tax shelter, because endowments have a different income tax rate and a capital gains tax rate to individuals. So if you're somebody who pays a lot of income tax, and a lot of income tax to me means over the 30% income tax rate, then an endowment does become quite attractive, because if you put money in there, the endowment will pay tax every year on the income. You won't, the endowment will. And it will pay capital gains tax also at a lower rate than those that pay very high rates of tax. But after a period of 5 years or longer, but it must be 5 years minimum, if you decide to take your money out of the endowment, that money will be tax-free in your hands, because the endowment has been paying tax every year that it's been going. So it's it often gets missold by agents, where they say this is a tax-free investment. That's not true. I mean, it does pay tax all the time. So it's certainly not as if it competes with a tax-free savings account. But what does bother me is a lot of the time these endowments are sold to investors as an education policy, for example. Set aside an education policy for your child and put it in an endowment. The issue with that is if you are a low income taxpayer, let's say your tax rate's only 25%, you're actually putting your money into a product which is going to be taxed at a higher rate than you would be taxed. So then it becomes a lousy place to invest for your kids' education. So I think it's very attractive for things like family trusts. It's very attractive for investment companies, and very attractive for very high income taxpayers. But you need to know that the 5-year term is really important there. The last point, I think, is that they are offered by, although it's an insurance product, they're also offered by a lot of unit trust companies who've applied for an investment license related to these insurance products. So it's not like you suddenly, you go to a unit trust company, they're going to sell you a life policy, on your death or something like that. They're going to sell you a pure investment policy, which is covered under this life assurance regulations. So those would be my preferred entry points, to be very honest. If I'm going to buy an endowment for a trust or a very high income tax person, I wouldn't generally go to the insurance companies, just because they're really expensive.
We must leave it there. Thank you, Warren Ingram. Warren Ingram is a personal financial advisor and executive director at Galileo Capital.